There's good news and bad news in the economy. The good news is that wages have increased faster than inflation. The bad news could also be considered that wages are rising, and that's going to affect the Reserve Bank's thinking about when to drop interest rates. So that's what I'm going to chat with Dr. Andrew Wilson about today in our weekly Property Insider discussion. We're also going to be talking about the strength of our property markets based on the very strong auction results, and Andrew is going to share an interesting chart about how many more sales at auction have occurred so far this year compared to 12 months ago. It'll give you a good insight into the depth of our housing markets. So if you're interested in property, please subscribe to this channel and click the little bell icon so we can let you know each time a new show comes out. What's ahead for interest rates? Sure, we all want interest rates to fall, and currently the media is full of economists' forecasts as to when the first rate fall will occur. And just as we think we know what's ahead, we get hit out of the blue with news such as the strongest growth in weekly wage earnings since 2009. Of course, the risk is that wages growth could contribute to more persistent inflation and puts pressure on the Reserve Bank with its decisions about interest rates. So I'm keen to get Dr. Andrew Wilson's thoughts on what this latest data means, and also get his views on what's ahead for our housing markets, considering the strong auction results our housing markets are experiencing at the beginning of the year. Of course, auction results are a great in-time indicator of how buyers and sellers are feeling, but they're also a good leading indicator as to what's ahead for our house prices. Hi, Andrew.
Yes, good day, Michael. And look, a good introduction. And of course, we're getting that clickbait continuously now about the prospect of interest rate cuts. A lot of those who predicted that in America are really looking very foolish now because they've all backtracked, and it was almost a certainty in the eyes of the market and economists and commentators that the US would begin cutting rates in March. Now they've pushed that out to June. So I'm not sure whether it's just incompetence or, those that are pushing a particular barrow to get people to take a position and therefore make a margin on it. But that's another story. We've had similar, no surprise, comments in the Australian financial media regarding the prospect for interest rate cuts. Not just the latest data, but the data that has been coming through has certainly shown that the battle against inflation hasn't finished yet, and there's still some hard yards to go. And that was reinforced by the National Wage Index that was released for the December quarter by the ABS. Another strong increase over the quarter, the December quarter, up 0.9%. It wasn't as strong as the 1.3% reported over the September quarter, which was a record quarterly increase, Michael, 1.3%. Annual wages growth is now surging from 4.1% to a near record 4.2%. So the wage index has increased by 4.2%, and that's the highest since the December quarter 2008, Michael, where we had the record 4.3%. If you remember back then, we were just at the end of a remarkable period through a mining boom, and we were entering into the global financial crisis. But that did cover the obviously the year before, which was 2007, which was a very, very strong year. So we're tracking at those levels at the moment. There is a bit of a lag in this, of course, because the wage index does follow those wage decisions that are typically made annually. Australia has those annual wage reviews, typically, sometimes 2 yearly wage reviews. So there is a lag in terms of wages catching up with prices, which is a little different to the US, which they have more of a real-time reflection of wages in terms of particularly prices, whereas we have this lag. But certainly this is more bad news for the rate outlook in terms of those that were hoping, I guess, and we all hope for lower rates as long as we've still got a strong economy. But it does mean higher inflation typically because, of course, if you're getting extra money, you just go out and spend it, don't you, Michael? And that puts upward pressure, particularly if supply still remains below demand, aggregate demand in the economy. And the point to the outlook is that all states, even though we've had a bit of an upward tick in the unemployment rate, all states are still reporting very low jobless numbers historically. And that, of course, means that the shortage of labour will continue to leverage employers to increase wages. But look, good news for wage earners that wages are continuing to rise in the face of strong inflation. Real wages growth is now getting closer to zero. We've actually been going backwards because inflation's been rising faster than wages. But nonetheless, it's another factor that shows we still have a battle to wage in terms of the outlook for interest rates and inflation. And we can see that when we look at the chart of the wage index, how sharply it has increased since the higher interest rate period, and certainly post-COVID, and driven by those stimulus packages. And when we look back to that very strong mining boom period in the early noughties up to the GFC, we can see how consistently strong wages growth was then. And of course, we had a period there of higher rates through 2005 up to 2007, Michael, which did reflect the impact of those higher wages. The Reserve Bank then trying to cope with higher inflation. Interestingly, Michael, we also had average weekly earnings data out from the ABS also, and that correlates what we saw in terms of the increase in the wage index. No surprise, of course. When we break it down over the year, Australia was up by 4.5%, average weekly adult earnings up by 4.5%. It's interesting when we see the breakdown of the increase in weekly earnings on a state-by-state basis, Michael. Western Australia and the Northern Territory and Tasmania were the top performers in terms of growth, but the ACT and Victoria were the underperformers. And it's interesting that the ACT and Victoria, Michael, have been the underperformers in the housing market as well, and they're lagging the other states clearly in terms of average weekly earnings. And we know that Victorian economy is certainly the underperformer compared to the other states. So just a validation of that.
Andrew, it's also interesting when you look at different industries, they earn different amounts. So the healthcare and social assistance industries, wages went up 5.5%. And at the other extreme, finance and insurance industries had the lowest annual wage growth of 3.2%. So we're not all enjoying the same wages growth.
Yeah, Michael, that's right. And of course, those sectors are exposed to higher interest rates and are more about the capacity of households to match their purchases in terms of higher interest rates. But when we look at the average weekly earnings, Western Australia is the top performer in November with average weekly earnings of $2,108, followed closely by the ACT, $2,088. Tasmania and South Australia, the underperformers. But it is interesting that New South Wales, Victoria and Queensland all have very, very similar average weekly earnings. New South Wales a little higher, and that works its way, I guess, into a sense of affordability, housing affordability. When we look at the capacity to repay a loan, obviously with higher prices, particularly in Sydney compared to Melbourne and Brisbane, it means that affordability is actually higher in Brisbane and Melbourne compared to Sydney. But once again, just a validation that incomes are growing. And that's not good news for tapering inflation, because higher incomes typically lead to more spending. And unless we have the productivity growth associated with those higher earnings, it means that wage payers, employers, have to push up their prices to cover the extra income or the extra wages that they're paying. So some good news there for consumers in terms of at least offsetting the impact of higher inflation, but not good news for the Reserve Bank or for those looking for lower interest rates anytime soon, because this is still stoking that inflation fire to some degree. But we have seen inflation fall quite sharply since its peak a year ago, Michael. So we're hopeful that that will continue to occur. But certainly, as I've said before, there's some work to be done yet.
Well, the Reserve Bank hasn't ruled out the possibility of rate rises. They're being very cautious in their minutes at the moment, aren't they?
Yes, and I think it's interesting when we look at the minutes from the latest meeting, which of course is 3 weeks ago. We have another meeting coming up shortly, but the RBA, to their credit, certainly hasn't bought into the speculating about interest rate cuts. They're still quite adamant there's work to be done in terms of bringing inflation down to the target. They don't have the confidence there to say that that's going to occur. Uncertainty about the economic outlook is still high. They said that putting all that together, that it's still appropriate not to rule out further increases in interest rates. And I think that's a bit of a breath of fresh air, given other central banks, particularly the US, have been speculating wrongly on interest rate cuts, and the markets there have picked that up almost hysterically. And as I mentioned before, they've now backtracked quite severely, and the markets are saying, well, it won't be until June. We get the underlying inflation data out for the US this week, and that'll certainly set the tone for the conversations regarding the outlook for interest rates and the potential for cuts. But as I said, I think that's been a reasonable and a rational statement from the Reserve Bank to their credit, and they did also say that they would expect fewer reductions in the policy rate compared to other advanced economies, and that reflects the fact that our official rates are lower than particularly the US and similar other advanced economies. So I thought that was worth repeating or viewing the minutes. And as I said, I think that was a reasonable assessment of what we're carrying. Certainly those that were predicting hysterically almost the interest rate cuts have had to take a very cold shower on that one.
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options? We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Well, the other people that have sort of hibernated are the property bears. They were out last year telling us how bad our markets are going to be. But the property markets have surged at the beginning of the year. Now, in a couple of days' time, My Housing Market's end of month figures for February are coming out. So I'm looking forward to catching up with you midweek to discuss those. But the auction markets give us a reasonable idea of how things are going on the ground. Boy, did we have a lot of auctions last weekend, Andrew.
Extraordinary numbers of auctions we're getting coming into the market, Mike. And we can't say it's a bailout, sort of sellers wanting to take advantage of the market because they don't have positive prospects or they feel there aren't positive prospects going forward, because markets rose strongly last year. Most of the major capitals up by 10%, some closer to 15%. So certainly ahead of steam brewing through the year. Typically, we see auction markets start the year about where they finished the previous year, but markets have been stronger this year just about across the board. But the real standout has been the actual numbers of auctions. These are actually unprecedented numbers for February, and still clearance rates very much positive. Sydney had a very big auction weekend last weekend, and remembering this is February we're talking about, and once upon a time Sydney didn't have 1,000 auctions as an all-time record, much less in late summer, and 1,004 auctions in Sydney to end the month. Clearance rate of 73.7, a little bit down on the previous weekend, Michael, but there were 400 extra auctions, so a lot more choice there for buyers. So perhaps that moderated the clearance rate a little bit. But when we look at the same weekend last year, it's a stark difference. There were just 686 auctions in Sydney for a similar clearance rate. Now, Melbourne was spectacular, 1,263 auctions. Yes, 1,263 auctions. A clearance rate a little bit under 70%, but nonetheless quite a solid clearance rate. But given the fact that there were 400 extra auctions in Melbourne compared to the previous weekend, and once again comparing to the 986 we had over the same weekend last year, which was the Super Saturday weekend, Michael. And there's something in regard to that in terms of having higher numbers earlier, because we're further out from the Labor Day weekend in Melbourne. But we'll still get around about 1,400 auctions next weekend, which will again be a big number. But even Brisbane and Adelaide and Canberra had very big weekends for auctions as well. 102 auctions in Brisbane, clearance rate just under 60%. Adelaide back to the 80s after having a few weekends in the 70s. 80% clearance rate from 108 auctions. Again, these numbers are very much higher than the same weekend last year. And Canberra also had a big weekend in auction, and it had its best clearance rate for some time as well. And that Canberra market has certainly been subdued compared to the performances of the other capital city markets. But a very big start to the year. We'll put that in context, Michael. When we look at the trends, we can see that Sydney's tracking well above where it finished last year, and also in terms of its monthly clearance rates, and also where it was at the beginning of last year, where it was certainly starting to have a revival. The same story in Melbourne, well above where it finished last year, the last few months of last year, and also higher than February last year. Same story in Brisbane. Well, not so much the same story, certainly higher than the end of last year and similar to the beginning of the year. And Adelaide's starting to pick up now. It's higher than where it was in December, but still below where it was in February last year. And the Canberra market still steady, but certainly underperforming compared to the other major capitals. I think when we put that all together, Michael, and I put this on a slide just to look at the comparisons with the February weekend auction sales. So these are actual sales. We're taking the actual number of sales. So that puts together the listings and the clearance rates and gives us the number of sales. And we can see a big disparity between the number of properties that have been sold over on weekend auctions in February this year compared to last year, using the same methodology for each February set. Sydney up by 42.7%, Michael. So Sydney's had 42.7% more sales over February this year compared to February last year. These are weekend auction sales. Melbourne up 27.6%, Brisbane up 29%. Adelaide up 6.2%. Canberra's still lower, Michael, down by 21.8%. But certainly Melbourne and Sydney in particular has a head of steam up to start the year, and Melbourne also doing quite well, and Brisbane continues to keep on keeping on. And we've mentioned that home prices in Melbourne and Sydney are actually still below where they were at their previous cyclical peaks, Michael, which was in March of 2022. So there's still value in that market, and I think that's driving increased buyer activity, which we clearly have when we look at that data. So if you're looking for the latest auction results, you can get them on my LinkedIn page on a Saturday night, which is the capital city snapshot. Then we get Michael and myself also release the national report on a Sunday, which gives you the breakdowns in terms of the regions for Melbourne and Sydney.
Great. Well, that's obviously a fantastic start for 2024. Yeah. And I look forward to catching up in a couple of days' time to see how all this translates into the numbers for the first 2 months of the year. Thanks for your time, Andrew.
Thanks, Michael.